Gold and silver just did something markets haven't seen in weeks. A single-day surge, over 4% in hours, silver briefly spiking past 5%. Resistance levels that held for weeks, shattered in an afternoon. And the reason behind it has almost nothing to do with the headlines everyone is chasing. Because while traders are celebrating a possible geopolitical deal, the real story is buried inside a jobs report almost nobody is talking about. Stay with us, because what happens next could decide where gold and silver go for the rest of the year. Welcome back to Currency Arc Insight, the channel dedicated to decoding the forces shaping gold, silver, and the global economy before the headlines catch up. If you are new here, consider subscribing, because what we are about to break down affects far more than a single trading session. On a quiet afternoon in the financial markets, something rare happened. Gold and silver, two of the oldest stores of wealth known to mankind, surged higher in a single trading session in a way that caught even experienced analysts off guard. Gold climbed more than 4%. Silver moved even faster, briefly rising above 5% before settling into a strong close. For investors who had been waiting patiently through weeks of sideways trading, this was the kind of move that demanded attention. To understand why this mattered so much, one has to look at where prices had been stuck. Silver had spent recent weeks fighting against a wall of resistance near $60 to $61 an ounce. Every time it approached that zone, sellers stepped in and pushed it back down. Gold faced a similar battle near its own recent highs. These resistance levels were not just numbers on a chart. They represented the collective hesitation of the market, the point where buyers and sellers had been locked in a standoff for days. Then, without much warning, that standoff broke. Both metals pushed straight through their ceilings and kept climbing. Gold touched levels above $4,200 an ounce. Silver reached past $62 before the session ended. For traders watching the charts, a breakout like this after such a long period of consolidation often signals something bigger is happening beneath the surface. It is rarely just noise. The mainstream explanation offered by most financial media pointed to geopolitics. A report suggested that a deal might be forming to reopen a critical global shipping route, one that had been a source of tension for weeks. The idea was simple. If tensions eased, energy markets would calm down, inflation fears would ease, and central banks would have less pressure to keep interest rates high. That kind of narrative makes for an easy headline, and it certainly played a role in the initial excitement. But seasoned observers of gold and silver know that headlines rarely tell the whole story. Precious metals do not move 4% in a single day simply because of political speculation. There has to be something more structural happening underneath, something tied to the real economic engine of the country. And that is exactly what was unfolding, even if most people were not paying attention to it yet. While traders celebrated the possibility of eased tensions overseas, the US dollar was quietly sliding. The dollar index dropped below the key at 100 level, a threshold that tends to draw attention from currency watchers around the world. A weaker dollar makes gold and silver more attractive, since both metals are priced in dollars and become cheaper for buyers using other currencies. At the same time, oil prices slipped lower, adding to the sense that global risk was easing. Yet beneath this surface, calm cracks were beginning to show elsewhere in the economy. The kind of cracks that do not make flashy headlines but matter far more to the long-term direction of gold and silver. These cracks were tied not to shipping lanes or diplomatic talks, but to something much closer to home, something that speaks directly to the health of the labor market and the broader economy. This is where the real story begins to take shape. Because while the world was distracted by the promise of a geopolitical resolution, a quieter signal was emerging from the data, one that suggested the economy might be losing steam faster than most people realized. And when the labor market starts to weaken, the entire calculation around interest rates, inflation, and monetary policy begins to shift in a direction that has historically favored gold and silver. The breakout through resistance was not just a technical event. It was the market beginning to price in a future that few had fully considered. And to understand what that future might look like, it is necessary to look past the headlines and into the numbers that truly move markets behind the scenes. Every big move in the markets needs a spark, and this time, the spark came from an unexpected corner of the world. Reports began circulating that a deal might be forming to reopen a critical waterway, one that had been at the center of tension for weeks. Traders reacted almost immediately. Within hours, the mood across financial markets shifted from cautious to hopeful, and that shift rippled straight into the price of gold and silver. The logic behind the reaction was simple to follow. If a major shipping route reopened, energy supplies would flow more freely. Oil prices would likely ease. Inflation pressure tied to energy costs would soften. And if inflation cooled even slightly, the central bank would face less pressure to keep interest rates elevated. For markets that had spent months bracing for tighter policy, even the possibility of relief was enough to trigger a wave of buying. What made this moment interesting was not just the headline itself, but how quickly the market moved to price it in. Political statements and diplomatic signals are often vague, filled with conditional language and shifting timelines. Yet traders did not wait for confirmation. They acted on probability, not certainty, which is often how markets behave when uncertainty has been building for a long time. People were tired of waiting, and any sign of resolution was treated as an opportunity. As optimism spread, the US dollar began to slide. The dollar index, which measures the currency's strength against a basket of other major currencies, dropped below the psychologically important level of 100. For those who follow currency markets closely, this threshold carries weight. It often marks a shift in sentiment, a signal that confidence in the dollar's near-term strength is fading, even if only slightly. This decline in the dollar mattered enormously for gold and silver. Both metals are priced in dollars on global markets, which means their price has an inverse relationship with the currency's strength. When the dollar weakens, gold and silver become cheaper for buyers holding other currencies, which tends to increase global demand. It also makes the metals more attractive to domestic investors, who see a weaker dollar as a warning sign about future purchasing power. At the same time, oil prices moved lower, falling below the $75 mark per barrel. While the drop was not massive on its own, it added another layer of confirmation to the broader narrative. Lower oil prices are often read as a sign of easing geopolitical risk, reinforcing the idea that global tensions might finally be cooling after months of uncertainty. Together, the weakening dollar and falling oil prices created what many traders call a risk-on environment, a shift where investors feel more comfortable moving away from safety and toward assets tied to growth and speculation. Normally, this kind of environment can actually work against gold, since the metal is often seen as a safe haven that performs best during times of fear. But this time was different because the dollar's weakness gave gold and silver a boost that had nothing to do with fear at all. This is an important distinction that many casual observers miss. Gold does not only rise during moments of panic, it can also rise simply because the currency it is priced in is losing strength. In this case, both forces were working together. A hopeful geopolitical narrative was easing fear, while a weakening dollar was quietly making precious metals more valuable in relative terms. For many traders, this combination felt like the perfect short-term setup. A reason to buy tied to optimism, paired with a currency move that supported higher prices on its own. Yet for those who study markets more closely, the geopolitical story alone rarely explains a move this large. There had to be something deeper reinforcing the rally, something structural rather than emotional, and that deeper force was already forming quietly behind the scenes inside a part of the economy that most headlines had completely overlooked, one that would soon reveal itself as the true foundation behind this powerful move in gold and silver. Behind every major move in gold and silver, there is almost always a central bank quietly pulling the strings, and this moment was no exception. While traders celebrated the geopolitical headlines and the weakening dollar, a much bigger force was reshaping expectations in the background. That force was the Federal Reserve and the way markets were suddenly rethinking its next move. Just 1 week earlier, the consensus among traders was that the central bank would likely raise interest rates twice more before the year came to a close. That expectation had been baked into asset prices for weeks, weighing on gold and silver since higher interest rates tend to make non-yielding assets like precious metals less attractive compared to interest-bearing investments. But in the span of just a few trading sessions, that outlook flipped. Markets began pricing in only a single rate increase by year-end, a dramatic shift in sentiment that caught many analysts off guard. This change did not happen in isolation. It followed the central bank's decision to hold interest rates steady for a fifth consecutive meeting, a signal that policymakers were growing increasingly cautious about tightening further. What made this decision even more notable was the presence of internal disagreement. A handful of officials had actually favored raising rates at that meeting, revealing a divide within the committee about how to balance the ongoing fight against inflation with growing concerns about economic slowdown. For those who follow monetary policy closely, this kind of split often signals a turning point. When policymakers cannot agree on the right path forward, it usually means the economic data itself has become harder to read, sending mixed signals that make confident decision-making increasingly difficult. And when the Federal Reserve becomes hesitant, markets tend to interpret that hesitation as an early sign that the tightening cycle may be nearing its end. Attention quickly turned toward the central bank's upcoming meetings, with traders closely dissecting probability estimates for each one. For the meeting scheduled in September, the odds were split almost evenly, with a slight lean toward another pause rather than a hike. Moving into the meeting expected in October, sentiment shifted further, with a growing share of traders betting on the possibility of a rate increase, though opinions remained divided. By the time attention turned to the December meeting, expectations had shifted again, with most traders now anticipating some form of rate increase by year-end, even if smaller than originally expected earlier in the year. This kind of shifting probability landscape might seem like a technical detail reserved for economists, but its impact on gold and silver is anything but small. Interest rate expectations directly influence the opportunity cost of holding precious metals. When rates are expected to rise sharply, investors often prefer assets that generate yield, since gold and silver produce no interest or dividends on their own. But when expectations shift toward fewer rate hikes, or even the possibility of future rate cuts, the appeal of holding physical metals increases substantially. This is precisely the dynamic that unfolded in real time. As the probability of aggressive tightening diminished, capital that had been sitting on the sidelines waiting for clarity began moving back into gold and silver. Traders were no longer positioning purely for inflation protection or geopolitical safety. They were beginning to price in a future where borrowing costs stay lower for longer, a future that, historically, has been extremely favorable for precious metals. Yet this shift in Fed expectations did not happen randomly. It followed real economic signals, ones that pointed toward a labor market losing momentum faster than many had anticipated. The central bank does not change its tone without reason, and the reason behind this particular shift was about to reveal itself through one of the most closely watched economic reports in the country. That report would soon make it clear that something far more significant than shipping routes or currency movements was quietly reshaping the outlook for gold and silver, something rooted deep inside the engine of the American economy itself. While most of the financial world stayed fixed on headlines about shipping routes and currency moves, a quieter report was released that carried far more weight than anyone initially realized. It came from a private payroll tracker that monitors hiring across the country each month. And this time, the numbers told a story that stood in sharp contrast to the optimism spreading through the markets. Economists had expected hiring to slow slightly, with forecasts pointing to roughly 75,000 new jobs added during the month. Instead, the actual number came in far lower, landing at just 44,000. This was not a minor miss. It represented a significant gap between expectation and reality, and it followed an already weaker reading from the previous month, which itself had been revised down to 95,000. 2 months in a row now showed hiring losing momentum, and the trend line was beginning to point in a direction that made economists uneasy. Numbers alone rarely tell the full story, so analysts quickly turned their attention to which sectors were driving the weakness. Education and healthcare continued to add jobs, showing resilience in industries tied to essential services. But leisure and hospitality told a very different story, actually losing jobs during the month. This sector tends to be one of the first to show cracks when consumer spending slows, since it depends heavily on discretionary income. When people cut back on dining out, travel, and entertainment, businesses in this space often feel the impact before almost anyone else in the economy does. This kind of sector-level weakness matters because it often serves as an early warning sign. Leisure and hospitality employment tends to be a sensitive indicator of consumer confidence, and when it begins contracting, it can suggest that households are tightening their belts in response to financial pressure. Combined with a broader slowdown in overall hiring, the picture starts to look less like a temporary blip and more like the early stages of a genuine economic cooldown. There was another detail buried within the report that deserved attention as well. Wage growth, while still positive, showed signs of moderating. Annual pay gains remained above 4%, which sounds strong on the surface, but for many workers, that growth still struggled to outpace the rising cost of living. This gap between wage growth and real-world affordability continues to weigh on household finances, even when headline numbers appear stable. For those who study the relationship between labor markets and monetary policy, this report carried significant implications. The central bank operates under a dual mandate, balancing the goal of stable prices with the goal of maximum employment. When employment data begins to weaken, it shifts the balance of that mandate, giving policymakers more reason to ease off aggressive interest rate policies in order to support the job market. This is precisely why weaker employment data tends to be interpreted as bullish for gold and silver. Slower hiring increases the likelihood of a more accommodative central bank, and a more accommodative central bank historically supports higher prices for precious metals. This is the deeper thread that connects everything discussed so far. The geopolitical optimism, the weakening dollar, and the shifting expectations around interest rates were not separate, unrelated events. They were all being pulled together by an economy that was quietly losing strength beneath a surface that still looked calm to casual observers. The jobs report served as confirmation, a piece of hard data supporting what the market had already begun pricing in through its reaction across currencies, commodities, and rate expectations. For long-term investors in gold and silver, this kind of signal often matters more than any single day's price movement. It points toward a broader economic direction, one where growth slows, hiring weakens, and policymakers are pushed toward easier financial conditions. Understanding this connection between labor data and precious metals is exactly the kind of insight that separates short-term speculation from a genuinely informed investment strategy. And it sets the stage for the final piece of this puzzle, the question of what comes next. After walking through each piece of the puzzle, the picture becomes much clearer than the initial headline ever suggested. What looked like a simple reaction to geopolitical news was actually the result of three separate forces converging at the same moment, each one reinforcing the others in a way that rarely happens all at once. The first force was the promise of easing tensions abroad, a development that lifted market sentiment and gave traders a reason to feel optimistic. The second was a weakening dollar, which made gold and silver more attractive on a purely mathematical level, since both metals become cheaper for international buyers when the currency they are priced in loses strength. The third, and arguably the most important, was a labor market showing genuine signs of slowing down, which shifted expectations around future interest rate policy in a direction that historically favors precious metals. The natural question now becomes whether this rally can hold, or whether it is destined to fade the way so many sharp moves often do. History offers some guidance here, though never a guarantee. Sharp single-day surges driven purely by headlines often do pull back once the initial excitement wears off. Geopolitical deals can fall apart just as quickly as they come together, and traders who bought purely on that narrative may find themselves exiting just as fast if the story loses momentum. However, this situation appears to carry more depth than a typical headline-driven spike. The weakness in the jobs report was not a one-time anomaly. It followed a prior month that had already been revised lower, suggesting a pattern rather than a single, unusual data point. Patterns tend to matter more to policymakers than isolated numbers, and if this trend continues in the months ahead, it becomes increasingly difficult for the central bank to justify maintaining a restrictive stance on interest rates. This is where the real opportunity for gold and silver may lie, not in the temporary excitement of a geopolitical headline, but in the slower, more structural shift taking place within the broader economy. If hiring continues to soften and consumer spending in sectors like leisure and hospitality keeps contracting, pressure will likely build for the central bank to ease its approach sooner rather than later. And historically, environments where interest rates are falling, or expected to fall, tend to be some of the most favorable conditions for precious metals. There's also a psychological element worth considering. Markets often move ahead of confirmed data, pricing in expectations before the full picture becomes clear. This means that even before the central bank officially changes course, gold and silver can continue climbing, simply because investors believe that shift is coming. In many past cycles, some of the strongest gains in precious metals occurred not during the depths of an economic downturn, but in the period leading up to it, when awareness of weakening conditions was just beginning to spread. At the same time, caution remains warranted. A single jobs report, even a weak one, does not guarantee that a broader slowdown is underway. Economic data can be noisy, and future reports could just as easily surprise to the upside, reversing some of the current momentum. Prices that moved quickly in one direction can just as easily correct if upcoming data fails to confirm the trend that seemed to be forming. Still, for those paying close attention to the full picture rather than just the surface-level headlines, the message becomes fairly clear. This was not simply a story about diplomacy or a temporary shift in currency markets. It was a moment where the underlying economic engine began showing visible strain, and gold and silver responded the way they historically have during such periods, by acting as a store of value when confidence in growth and stability begins to waver. Whether this marks the beginning of a larger move or simply a temporary spike will depend heavily on what the data reveals in the weeks ahead. But one thing remains consistent throughout history. When the labor market weakens and central banks are forced to reconsider their path forward, gold and silver rarely stay quiet for long.